How to retire early, like really early. What, if anything, the news about the Department of Labor fiduciary rule means to you, and why Joe hates target date funds. This is Your Money, Your Wealth. Today on Your Money, Your Wealth, Joe and Big Al talk to the Listen Money Matters podcast's Andrew about real estate and retiring well before age 65. You know Big Al's got a list for you, and today it's the 7 essential retirement rules for anyone over 50. And the fellas answer emails about target date funds, making the most of your pension income, buying mom's house rather than inheriting it, and determining capital gains on the sale of a rental. Oh, and you'll find out why Joe's socks may be creating a conflict of interest. Here are certified financial planner Joe Anderson and CPA Big Al Clopine.
Hey, welcome to the show. Lots of things to discuss. Breaking news. I'm going right into this, Alan.
Okay, I can't wait.
You know, it's funny how it's shocking how quickly things can change.
Yes.
And our industry is the financial services industry. And Friday, I'm not sure if you've heard this, but President Trump wrote another executive order.
Okay.
And so things, and as you know, now the Dow Jones is up 20,000 and everyone's all excited. The market is extremely excited because we're going to roll back a lot of regulation, apparently.
Right.
And we've been talking about the DOL fiduciary rule for quite some time, since past couple of years. And it was supposed to come out or come into effect in April.
Correct. April 1st.
April 1st. And so what the DOL in the fiduciary rule is just a little backdrop for you. Is a fiduciary means this, is that if you're working with a professional, they're doing what's in your best interest. And most of the industry works on a suitability standard, which is that they're selling you a product which is decent for you, but it may or may not be in your absolute best interest. A lot of times advisors and brokers might have a fiduciary rule to their company, not necessarily to their clientele. So that creates conflicts of interest when you are positioning a product or a solution that might compensate that firm or that particular broker or advisor or salesperson or whatever that you want to call the individual, a little bit more compensation versus another solution.
Right, and you could probably say, it's not definite conflicts of interest, but there's more likelihood, I guess.
Sure, mm-hmm. Yeah, that's a good point. There's a lot of really great advisors all across the spectrum.
Absolutely.
And there's some bad apples, right, that kind of ruin the bunch.
Right. And
so what they wanted to do is the DOL stepped in and said, you know what, in retirement plans, we would like everyone that is giving advice or helping individuals in their retirement plan, so an IRA, for instance, individual retirement account or 401k, they have to act as a fiduciary, which means is that they have to act in your best interest. And so a lot of these different companies were going haywire. The financial services industry was up in arms. They were suing the DOL, saying, what are you doing? You're overstepping your bounds and everything else. But when you look at it, if they're acting as a fiduciary, I think that's a good thing, right? But then there's arguments saying, well, maybe the consumer that doesn't necessarily have a lot of assets that would still like to get advice, they might not be able to get that advice because these firms wouldn't be able to afford to take them on without any sort of reasonable compensation. So I understand that argument. But at the end of the day, you should be working with someone that has your best interest, and it should be in writing.
Yeah, to me, Joe, it's surprising, I think, to a lot of folks when we talk about this, that they just assume that advisors have to look out for their best interest, and that's actually not how the industry is primarily set up. Now, of course, there's a fee-only movement, which we're part of, where we're fiduciaries, but a lot of the industry is still the old-fashioned way under a suitability standard, as you mentioned, and boy, the uproar from the industry over this Department of Labor regulation, and of course, a lot of the industry wanted Donald Trump to get into the office so they could roll it back, and that appears to be exactly what's going on.
Right, and so stay tuned.
Right,
he drafted the executive order on Friday.
Yeah, what I'm not completely clear on it, Joe, but what I read was that it's an executive order, and it's not like cast in stone. It's more of a this is his thoughts, and we got to relook at this.
Sure, it's like a revamp of it.
Right.
And I've also heard some other arguments as saying, yes, there needs to be a fiduciary rule, but maybe it should come from the SEC versus the DOL.
Yeah, and that, you know what?
And the SEC is the Securities Exchange Commission that regulates the industry.
That's probably valid. That's
Probably
true.
Better way to look at things.
Yeah,
sure.
I mean, that's the agency that you would think would be watching over for this sort of thing a little bit more than the Department of Labor.
So I guess just FYI, if you were anticipating things because a lot of these companies came out publicly, the big brokerage firms, and say, all right, well, from now on in retirement accounts, we will just charge a fee for the advice versus any type of commissionable products. Other people were kind of sitting on the sidelines just to kind of see, wait and see type of thing.
Sure, right.
But just FYI, buyer beware, of course. If it sounds too good to be true, in most cases it probably is. Some of the things that were on top of the list, of course, were some packaged products that, such maybe as an annuity of some sort that was guaranteeing XYZ. I think if you dive in deep of some of, let's say, a fixed index annuity with a guaranteed income rider on it, how they're sold and how they work might be two different things. But if you get into the weeds with the product and you truly understand how it works and then purchase it, then you've done your due diligence. But I think a lot of times you might hear there's certain guarantees there's guarantees there, but it's not the guarantee that you anticipated, such as a 7% guarantee on the money. Well, no, that's a roll-up for your guaranteed income, and sometimes it's not fully disclosed. Then you have the non-traded REITs where there's very little liquidity and you don't know, and very little transparency, so you're not sure exactly what your income really is. Is it return of principal? Is it actual income from the properties that you're purchasing? So the fiduciary rule will probably be kicked down the road a little bit, as they say.
I would say so. And I guess if you really can't tell from our discussion, we were for it because we think that the industry should be under the fiduciary standard. And I think you will find that most fee-only financial planners are all for it. I mean, this to me is how the industry should move. There was a lot of lobbying by the insurance companies, by the big brokerage houses, because they didn't want this to go into effect because all of a sudden their way of doing business would fundamentally change.
Well, because now they're held liable, right? Then you can sue.
Sure.
There'll be class action lawsuits. If one person said, hey, they sold me this product and they should have been acting as a fiduciary versus the suitability standard.
Right.
And if I have a big brokerage firm with thousands of different advisors, the oversight on that is fairly challenging.
That's true. And so I can understand it from their standpoint to administer this whole thing. And maybe this should be revamped, but the spirit of it, I think, is correct.
No, I agree with you 100%. We'll talk more about this, I guess, as
time goes on.
As we
see how this rolls out.
We get a little clarity on exactly what's going on. But like rollovers, for instance, let's say if you have a 401k plan, and a lot of times advisors, our firm is one of them that would say, all right, do you want to keep it in the 401k or would you roll it into your own individual retirement account? Depending on the circumstance of the individual client, but I would say the majority of the time the advice is to roll it over. And I think there's a lot of good reasons to roll it over. Such you get professional management of it, you get tax efficiencies from it, you have someone that's not necessarily emotional tied to your money. So there's a lot of pros, but there's also some cons there too.
There are. Of course, there's generally more investment choices in your own IRA versus your 401k. But yeah, you're right, there are some cons, and some of the cons come down to the advisor that you pick, because some advisors are going to sell you expensive product and you may not even know it, where you would have been better off staying in your 401k.
Right. And then I think everything is so glued on fees. And I guess this is kind of biased because our firm, of course, charges fees. But it's the behavior that takes way more of the overall account balance than a fee, if it's a reasonable fee.
Yeah,
right?
And so what we're saying is if the market, and we see this every year with Dalbar studies, they look at what the market has performed versus what the average investor has earned on the basis of their behavior when they get into the market, when they get out of the market. And Joe, every year it's somewhere between maybe on the low side 3% rate of return that you lost just by being an investor.
It could be a 50 to 75% or less than what the market
That's right.
brings.
And we've seen 6 or 7% rate of return. In other words, the market's earning 10 and you're earning 3 because you're buying and selling at the wrong times. You're buying when the market is going up, when you're excited, so you're buying high, and you're selling when it corrects, so you're freaking out, so you're selling low. And it's interesting, these Dalbar studies, in a lot of cases, if you have an advisor that can sort of keep you in your seat, for lack of a better term, and stay invested, you do a lot better over the long term. And actually that particular rate of return just from that is generally more than the fees, usually quite a bit more than the fees they're charging.
Right. We had Carl Richards on the show a few times, and he wrote the book, The Behavior Gap.
Right.
And so he did extensive research, including the research from Dalbar, of taking a look at the inflows and outflows of equity mutual funds of the average individual investor. And of course, when markets are at their peak, as we see today, we're seeing more and more inflows of equity type mutual funds. And when markets go down, then we see a lot of outflows of equity type mutual funds. So we're doing the exact opposite of what we should be doing because of the emotion that's involved with our money. And the closer we get to retirement, the more that we look at our overall money, and the more emotion is that much more real, because now I have to spend it versus save it. And there's all sorts of now new, PhD degrees in behavior when it comes to your
Sure.
overall finances.
Right.
So stay tuned. We'll talk a lot more about the DOL and what's going to happen there in the weeks and months to come. Alan, what lists do you have this week?
Well, I've got a good one to start with, Joe, and this is 7 essential retirement rules for anyone over 50.
7
Yes.
essential rules. I
Yeah,
guarantee you it's all fluff.
There might be some
Common
good stuff
sense.
in here.
Let's
Could
have
be.
a little dose of common
But
sense.
before I jump right into it, the Pew Research Center estimates that about 10,000 baby boomers are expected to retire each day until 2030. We've been saying that statistic for years. Now we know when it stops. We never have computed this, Joe. So it's 2030.
30. All right.
Right?
So 13 years.
13 years from now.
All right.
Right? So as a consequence...
And then it goes to what, 9,900?
well, then there's no more baby boomers. They're already all retired.
All right. So here's I got a question. I'm sorry. But
Yeah.
All right. So because of this age wave, right, you got these 10,000 baby boomers turning 65 every day for
Sure.
the next 13 years.
Right.
All right. And so with that... they're talking about the solvency of Social Security because there's so many people now at age 65 or close to full retirement age.
As a percentage higher versus any other time in our history.
So then they're looking at, all right, well, let's look at the trust fund, the OASDI fund, and how, because more money's going out of that fund that is actually getting funded at this point.
Right.
Because of the baby boomers are retiring, right? And then so by 2037 or so, then it's about 80% of it is going to be able, or 80% of the obligations would be able to get paid because the trust fund is now zero.
Yeah, in other words, if the trust fund runs out, which it's projected to, I've seen anywhere between 2034 and 2037, 2038. I guess it went up lately because the market's done better. But at any rate, the thing is, even if the trust fund is out of money, there's still money coming in. So the last I saw, it's 77% of your benefits you'll still get anyway. And a lot of people don't realize it. They think it's going to be zero, right? And of course, that's if there's no changes in Social Security, which there will be.
Right. But then here's the other question that I have. What is the largest demographic that we are living? I mean, so you got the greatest generation, you got the baby boomers, you got Generation X, you got Generation Y and the millennials, and
Correct.
Then now you have Generation
The next one. I don't know what
Z,
the next
I
one
don't
is.
know, whatever.
Yeah.
Okay? Out of those generations, which is the largest?
Which is the largest? I think the millennials, maybe.
The millennials are,
Yeah,
right?
yeah. Which we've always said it's baby boomers always, and
Always.
now the millennials have taken over.
Exactly. So the millennials are the largest generation. And so, all right, well, let's just fast forward to 2034.
Right.
Okay. Well, the millennials are the largest generation. They will be in the workforce paying FICA tax. How does that thing run out?
Right. Well, and plus, Joe, this is something that they've tweaked and changed over time. They've raised the limits, they raised the percentages, they increased the retirement age. There's lots of ways to fix that, and everyone knows it's a fixable issue. No one wants to tackle it because it's a political hot
It's a
potato.
nightmare.
Yes,
Yeah,
right. But at any rate, that's Social Security. I will tell you is here to stay. It's not going anywhere.
Oh, boy.
How about
That's a
that?
pretty big statement there.
It is.
All right. What do you got for
You
your
want-
list there?
You want the 7 essential retirement rules? The first one is the dreaded B word.
budget?
Yes.
Don't budget.
But buckle down on a budget. This is written by Judith Ward in Forbes magazine. So general spending guideline is fine when you're years away from retirement, but now the rubber meets the road if you're 50 and older. Right? It's time to get serious about what your budget will be when you're retired. Track your spending carefully. Figure out what expenses you won't have and when you stop working and which expenses that may actually increase.
That sounds like way too much work, and most people won't do it. Here's an easier way to do this.
Yeah, give us a shortcut, Jay.
Right? I mean, here's a dry run through, because what we talk about quite a bit as you're saving money or as you're accumulating wealth through retirement is pay yourself first. Right? Find out how much money that you need to save. Do that, and then spend everything else. Who cares? You don't need a budget.
Right.
Just save first, then spend everything else. Right? Most people do the opposite. Right? They pay their bills, they go out to dinner, they do this, and all of a sudden there's nothing left at the end of the month.
Yeah, $100 maybe.
Yeah, maybe at $50.
Yeah.
Okay. But if you pay yourself first, so now you're retired. It's like, oh, now we got to buckle down and budget all this stuff. No, here's the simple steps that you need to take. Figure out what your fixed income sources are. What is your Social Security? What is your pensions? Do you have real estate income and so on? Add all those dollar figures up. So if you're married, of course, add your spouse's Social Security, your Social Security, if you have pensions. And let's assume I'm married, and let's assume that my Social Security is $20,000, my wife's is $20,000, so that's $40,000, and then maybe we have a small pension of another $10,000.
Right.
So $50,000 is our fixed income source, all right? Then I have to take a look at my assets. How much money do I have in retirement accounts versus mutual funds versus Roth accounts and so on and so forth? Then just take 4% of that number. So if I have $50,000 in fixed income and I have $100,000 saved, right?
Sure.
So 4% of that $100,000 is $4,000.
Okay.
So my income is $54,000.
So I take the 50 plus the 4.
50 plus the 4, $54,000. That's your budget, right? If you spend more than that, you will run out of money.
Yeah.
So,
Now-
I mean, if you look at it like that, that will take you 5 minutes to do.
Right.
Versus tracking your expenses for 90 days, and then you'll just get frustrated. Oh, honey, why are you spending? What did you do that again? Or what's that? So you took cash out of the cash machine? You got to tell me about that because I'm on this strict Excel spreadsheet. It's like figure that out, and then come up with an overall retirement income strategy to make sure that you're managing the assets, tax managing it okay, to take that 4% out, and how are you going to do it?
Yeah,
and so on.
I think that's a good exercise. And Joe, I like what you do when you teach classes. You ask people, well, how are you going to spend less in retirement? Oh yeah, I'm going to spend 75% of what I'm spending right now. And so then you ask the question the other way. Well, if we took 25% away from your salary today, could you afford your lifestyle? Oh, there's no way.
Absolutely not.
Spend every penny.
Right.
It's like,
well, of course I'm going to spend less in retirement. Well, how much are you going to spend less in retirement? Well, I don't know. We'll probably spend, 75%. Okay, so you're saving, so you can save 25%, and there's no chance in hell.
So anyway, that's a good exercise, right? Is to do a kind of a retirement, what do you call it?
Back of the envelope type analysis.
Yeah. So I had a more clever word, but that's all right. I'll think of it later. Here's number 2. Get cozy with your 401k, Joe. Cozy with your 401k. For years, you've thought of the 401k as money you couldn't touch. Now, this will be likely a valuable source of funding into retirement. If possible, talk to your company's benefits team to see how you can access your money after you leave. You may be able to leave your money in the plan and make periodic withdrawals. You may have to do a rollover to an IRA. And so you got to figure this stuff out. We were just talking about that.
Get cozy.
Cozy.
That's
No comments on that one? Okay, here's location. Where are you
going to live?
Are you staying put in retirement, or are you mulling a move?
Oh.
You like these words that are in this article.
Never mind.
Do you and your partner feel the same way about it? You want to live in Florida, a partner wants to live in Canada, right?
Right. Well, I mean, if you look at the statistics, most people want to stay in their home.
They do.
That's where your memories are. That's where you raised your kids. That's where everything else.
And
a very small percentage of people actually want to.
Not only do they want to stay in their home, they do stay in their home.
Right.
I mean, it's overwhelming majority. And the next one I got, determine your Social Security claiming strategy. Joe, did you know that the average Social Security payment in 2016 was $1,341 for an individual, or $2,212 for a couple, right? So $24,000, call it $26,000, $28,000 for a couple is the average. And here in Southern California, that would be a little bit difficult to make that work. However, averages are deceiving, right? Because I'll put it this way. If you're making a good salary, a lot of our listeners are, and if you're near the top or maybe even past the top of the Social Security cap, you can probably, what would you say, Joe? Probably if you retire at full retirement age, which is 66 in 2 years, you probably get somewhere around $2,000 per month. And if you go to age 70, it's probably about $3,000 per month in rough numbers, just to give you a sense. So those numbers are greater. If your spouse works, then you could potentially even double that. So it does depend on your salary, but the claiming strategies are crucial. So many people claim their benefits at 62.
Right. And I think there's confusion, too, on how it's actually calculated. So if you take a look at the last 35 years of earnings, the highest 35 years is how they calculate your PIA, primary insurance amount. So if you continue to work, we get this question quite a bit. It's like, all right, well, if I continue to work, is that going to hurt my Social Security benefit, or what? How does that happen, or what goes on there?
Right.
Your benefit, if you continue to work, will never go down. It would only go up or stay the same because they take the highest 35 years. So if you had, let's say, only 30 years of work history and you had those other 5 years, Social Security just plugs them in as zero.
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 Right? So even if you work part-time, it's going to help you.
It's going to help
Yeah,
you, right? As long as, you put into the system. So, and you could work until 70, 75. They'll still recalculate those dollars. So if you're going to continue to work past full retirement age, even if you decide to collect your benefit at 66, let's say, I collect my benefit at 66, but I'm young, spry, and I still want to work for another 10 years. Well, as you continue to work, and if you're at a high wage earner, right, they're just going to replace those higher wages with maybe a lower wage that you made 35 years ago. So your benefit is recalculated every single year. So it continues to recalc on you.
Right.
But if you do take it at 62, just know that you would receive about a 25% permanent haircut on those dollars. And if you're working full time, as you collected your benefit prior to full retirement age, you can't make more than about $16,000. Once you make more than 16 grand, they take $2 back, or they take $1 back every $2 that you earn. And then once you reach the year of your full retirement age, then it's about $40,000, $43,000, and then they take back $1 after every $3 earned after that threshold. So I'm only talking about once your full retirement age, you can collect your benefit, you can make X amount of dollars. They're not going to take any dollars back, and they don't take it and steal it, right? They just recalculate your benefit like you didn't take it for that month or that year or whatever, or however the calculation works out.
Yeah, and that's a good point, Joe, because we do get asked that all the time. Well, how much can I make and still receive Social Security benefits? And it depends on what age, right? So basically, if you're between 62 and 66, roughly, there's issues if you have earned income, and if it's before your year that you reach full retirement age, you can only make about $16,000. So don't take your benefits then, probably, if you're still working. Now, if you reach 66 years old in 2 months, as it is right now, and you want to take your benefits and you're still working full time, well, you can. You get full benefits after full retirement age, 66 years and 2 months. You still, though, may want to wait till age 70, right? Because if you wait till 70, you're going to get roughly 30 to 32% higher benefit than if you took it at that 66-year age, right? And so here's the thing, is if you're working and don't need Social Security, why take it? Because it just keeps growing each and every month for the rest of your life by you delaying it.
Right. And then there's all sorts of different, opinions. Is like, well, I'm going to take it early, but then I'm going to invest it. Right, so then you have to look at all sorts of different crazy assumptions, and you're looking at crossover points and break even. We don't look at it that way. We look at Social Security as longevity insurance. It's like, all right, well, here, I'm going to receive an 8% delayed retirement credit on my benefit. That benefit is guaranteed by the federal government. Yes, you can take it early, and if you invest and you get a certain rate of return, are you going to be better off? Sure, it's depending on what type of assumptions that you make in regards to the amount that you think that you can grow that money at.
Yeah, that's a good point. If you think you can earn 15%,
then do it.
Take it early.
Yeah, take it early and invest it.
But most of us don't.
Right. Markets go up, markets go down, and you want to make sure that you have some form of, guaranteed fixed income. You can, and we feel that Social Security is a great source for that versus maybe purchasing an annuity or anything else for that matter.
Yeah, and part of that too is Social Security is not fully taxable. In worst case, 15% of Social Security is tax-free, and in some cases, none of it's taxable.
Right. It depends on how you toggle your income.
Right.
Right. Because you have full control of how that income potentially is going to be taxed in retirement, depending on how you set yourself up. If it's all in a retirement account, well, then you have very little control because it's taxed just like your paycheck when it comes to ordinary income tax and, state of California or whatever state that you live in. But if you have money in a brokerage account, let's say, maybe you have money in a Roth account, and you have money in a retirement account, then you have 3 different areas where you can draw your income from. Now you can start controlling the taxation, which is key. And then if you understand the provisional income when it comes to how Social Security is taxed, then you could really play with the numbers to make sure that you're doing everything appropriately up front. So when it comes time to collect your Social Security, to start drawing down your investment assets or taking distributions from it, you're doing it with the right tax mode.
Well, Joe, we're talking about 7 essential retirement rules for anyone over 50. And we sort of touched on this next one, which is probably the single most important one here, which is map out a strategy for withdrawals. Because once you stop working and the paychecks stop coming in, how are you going to pay for things? Because in addition to your regular income, and such as Social Security and pension income, you'll have to spend from your savings. And isn't that the whole reason you saved in the first place? Mm-hmm. And now it's a matter of which savings accounts do you take the money from? Do you take it from the IRA, from the 401k, from the Roth IRA, from your non-qualified, non-retirement account, or combination? The advice everyone gets, for the most part, is spend down your non-qualified money, your non-retirement money first, because it doesn't cause any taxes. And I would say in many cases, if not all cases, that's probably the exact wrong thing to do.
Yeah, it's very emotional as well, because now you're spending the money that you saved. And that's a very difficult thing for a lot of you to do. And I get it. It's like, well, no, I'm a saver. I'm not a spender.
Yeah, it is hard to change that.
Right? Because I think most of the time you look at your account balance and you like to see it go up.
Right.
But once you start taking money from the account, right? But then I'm averaging 10%, so I'm going to take 10% out.
Yeah.
Okay, well, then we've seen that disaster happen.
We have. The smarter thing is if you're taking out 4%, maybe you should be earning 6 or 7.
But I think a lot of times people are a little naive going into this, because once you start selling assets, right? It's like, well, what asset are you going to sell?
Right.
What strategy are you going to use? When are you going to sell it? Do you put a year or 2 years in cash, or do you just try to live off of the interest or dividends that it's kicking out and not spending anything else? And then getting more complex of, are you taking it from your IRA, your Roth IRA, or your brokerage account? How is that going to affect your Social Security benefits? I mean, there's a lot more to this. It gets very complex.
It does, and sometimes just simple things like, I've got these investments that I've had forever outside of retirement. If I sell them, there's big gains. And some people don't pay any attention to that. They sell them. They got these big gains where, if they're charitable, they could have given those highly appreciated securities right to their charity and get the deduction for what the stock is worth.
Right, they're giving cash to the charity or the church,
and not have to pay taxes on the gain, right? And it's funny because we talk to a lot of people. A lot of people don't even know you can do that charities will accept stocks instead of cash. So much smarter way to go, because then you avoid the capital gains tax on that.
And then once you reach 70 and a half, you can give your required minimum distribution directly to charity.
That's correct.
Here, I want to ask you a question here. All right, so here's the law. Up to $100,000 of your required distribution go directly to a charity.
That's right.
When would that make sense versus just saying, you know what, I'm going to give X and then just write that off as a deduction?
Yeah, so I think your question is, you can either, let's say your required distribution is $100,000, just to make it which means you got a lot in your IRA, your 401k, and let's say you're also very charitable. You want to give $100,000 away, so you can either withdraw the funds out of your IRA, 401k, and it's income on your return, right? And then you have a $100,000 donation, which is a write-off. So it would seem that whether you do it directly from your IRA, then it doesn't show up on your return, versus it's on the return as income and a deduction. It would seem to be the same, but there's lots of cases where you'd rather have it go directly to charity, because when you have the income, the required minimum distribution, on the front page of your 1040, it's part of your adjusted gross income. That impacts how much of your Social Security will be taxable. It impacts how much Medicare surtax that you might pay. It will impact whether your exemptions are being phased out. all kinds of stuff right there. And then the other thing, too, is when you give away big charitable donations, they're limited to your adjusted gross income. And you can get a situation where if you take the RMD and then record the charitable deduction, you don't get to deduct it all because your adjusted gross income isn't high enough. So there's lots of actually situations.
So I guess to dumb that thing down, Al, wow.
Yeah, you asked.
Geez. If I'm giving $10,000 to a charity and I have lower income, it's not necessarily, it's six in one hand, half dozen in another.
That would be the best time to do it, Joe, because if you're in lower income,
then it's going to affect the Social Security taxation.
Correct, exactly.
So there's a sweet spot where it's not going to make any difference, and then there's another sweet spot where it's going to make a ton of difference.
I would say honestly, so I'll try to dumb it down. So lower income, you definitely want to do that because.
All right, do what is directly take it from the IRA to the charity.
Yeah. Direct contribution to charity because less of your Social Security will be taxable. Or higher income, you want to do it because you'll stay out of that Medicare surtax and the phase outs, right?
Got it. All right.
And so to quantify that, I would say if your income is probably even with Social Security less than about, I don't know, 50 grand or so, then you might want to do the direct contribution because you're going to have less of your Social Security taxable. Or if your income's above 250, right, then it's going to be appropriate for you. And there could be reasons, Joe, where even if you're in the middle there, you might want to do it, but that's probably the sweet spot.
Joe and Big Al are always willing to answer your financial questions. Email info@purefinancial.com.
This is from Darren G.
Darren, okay.
I listened to you and have enjoyed it. Wow, that's a first.
I like it.
Some of the things you talk about are a little different. I especially like the discussion about having the cash bond stock split that look to balance the portfolio based on your ability to not have to sell a depreciated asset for a few year period. Basically suggesting a larger percentage of stocks risk is okay as long as there's enough cash or bonds to weather the downturn. Hope I got that right. So yeah, I mean, I think a lot of times when we say how much money should you have in stocks versus bonds is based on cash flow needs. It's not based on a stupid risk tolerance questionnaire. Right? It's like, all right, well, here, I need to develop $30,000 from the portfolio, and then that number is going to increase each year just due to the fact that I got to pay a little bit of tax on that, and then there's also inflation. And if my only fixed income sources is Social Security, then the 100% of the demand of that extra income has to come from my portfolio. So you want to make sure that you have a buffer there to say, you know what, I'm going to have at least 5 years of fixed income sources, or maybe 7 years or 10 years, really depending on the person, right? And what their overall asset base looks like and so on and so forth. It's very specific to that individual. But yeah, you get the gist, is that who cares if the market crashes, right? Because you have enough to weather the storm for the next 5 years. If you think well, markets go down, markets go up, markets go down, and markets go up. So you don't want to be selling an asset when it goes down. He goes on to say, so given that,
okay,
my question relates to how to treat pension income.
Okay.
All right. So when I look for pension money advice, there doesn't seem to be any logical explanation of the pension cash stock bond balance. My wife and I have a 6-figure annual pension payment for life, whoever lives the longest. If I treat that income as, let's say, a 5% bond payment, the present value is equal to our savings. Right? So, I mean, if you look at $100,000 fixed income,
yeah,
right, that's a couple $1,000,000 depending on, he's using 5%. So,
sure, right.
So it seems to me I should take on a lot more risk than, let's say, a 60-40 stock portfolio. Look to hear you discuss it on Saturday.
That's a great question, and I would say, Darren, yes, you can, if you want to, right? So here's the modified formula. Let's call it $100,000. You said 6-figure, and let's say you're spending $120,000, for example. So you need $20,000 from your portfolio. And Joe, to paraphrase what you just said, is in your case, since you got a lot of assets, let's make sure that you're good for 10 years. So let's say you need $20,000 a year. Let's multiply that by 10 years. So you ought to have at least $200,000.
And it sounds like he's got, let's say, a couple $1,000,000 in liquid assets.
Right, at least a couple $100,000 in fixed income, so that if the stock market were to go down for a decade, which, by the way, it never has except for the Great Recession.
That's only one market, though, right? That's only the S&P 500.
That's true.
If you look at emerging markets, small cap, and so on and so forth, those all went up.
That's true. So 10 years years would be actually plenty conservative. And just so you understand, when we're saying 10 years, it's not like that $200,000 is going to produce the income that you need. You're going to be selling some of those bonds to create the cash flow that you need, right? That's how this works. But then you can let the rest of your portfolio do its thing. It will come recovering as long as you believe in capitalism. If you don't believe in capitalism, then maybe you don't want to have that much risk. But that's the concept. Now, on the other hand, let's take the flip side, Joe, which is if in this case you have $2 million, so that would be $1.8 million in the market, $200,000 in fixed income. That may be more risk than you want to take. If you're the kind of guy or gal that will wake up in the middle of the night when your portfolio goes down 30%, 20%, then let's taper that back a bit. So you got to there's a lot of things you want to look at all at once.
Here's the hierarchy. And I agree with you 100%. The first part of this is to really take a look at the income need, right? And say, all right, well, if you need an additional $20,000 from the portfolio, or maybe it's zero from the portfolio, but to keep with the consistency of your example, is like, all right, well, here, I need $20,000. Let's do that by 10. Let's, take a present value calculation. You probably need about $250,000, $260,000 in safe investments given inflation over that 10-year period.
Yeah, exactly.
Right? We'll call it $300,000.
Okay.
Right, so $300,000, and then you take that, whatever else that you have, that would be the stock mix, and then you have $300,000 in tips, governments, treasuries, right? Maybe really high quality international bonds and so on.
Sure.
So then you know that those are going to be safe. Very short in duration, by the way. All right, short duration, high quality. So you're not going to see that variability or volatility in those bonds if you went longer term.
Right.
So that's the first step, right? Because now I covered my income need for the next 10 years. So if the market blows up, I'm all right with that over the short period of time because I know the recovery, right, I'm going to be safe for 10 years. So that's the first step. Then the second step is, what's the ultimate goal of the money? Is it for the kids? Is it for the grandkids? Is it for charity? Do you want to maximize that, right? If you say, no, I don't really, it's just us, whatever. Then third, then you say, all right, now what's the sleep factor?
Right.
Now where are you at? Because if that $2 million drops down to 1.5, you lost $500,000, let's say in a 6-month time period, what are you going to do? Are you going to freak out? Are you going to abandon the strategy? If the answer is yes, then you want to start toggling it really based on your specific kind of risk tolerance. But you don't start there, I guess is the point. Hey, how do you feel if the market dropped 20%? Well, everyone says, I would be pissed. It sucks. I lost a lot of money.
Right.
Right. And then it's how you feel at that moment of time when they ask you that question too. So that's why we're not big fans of that. We start with the full financial planning. What's the cash flow need? What's the tax implications? What's the overall goals of the money? And then we layer, some of the other stuff that the industry kind of leads with. Alan, I'm pretty excited right now.
Yeah, we've got another great guest.
Yeah, his name's Andrew. He hosts one of the best financial podcasts. It's called Listen, Money Matters.
And he agreed to come on our show?
I can't believe it. I got to pay this guy like $10,000. But hey, I want to get into this interview right away. So, Andrew, hey, thank you so much for taking a little bit of time out of your busy schedule to join us.
Hey, no problem. You're making me blush over here.
Hey, well, I got to ask you, I guess, what are you drinking?
Oh, my God. I'm not drinking anything. I'm terribly prepared to talk about personal finance right now.
Well, that's no fun.
Yeah, well, you got to crack a beer or something, right?
All right, I'm getting a bomber right now. Well, what are you guys drinking?
I got a coffee.
Yeah, Big L's old, man. He's got a cup of coffee, and I'm just jacked up on some energy drink. Well, let me ask you this. All right, so a little bit of background on yourself, what you work for. You're not even in the personal financial field, and you were like, you know what, hey, there's not enough information for individuals to really understand finance on a basic level to get into the weeds. Or why did you start the podcast? And tell our listeners a little bit about the genesis of it and more about your background.
Yeah, sure. So by day, I'm a data engineer, and I work with a lot of people who are manyfold smarter than me, but they really suck with money, and a lot of them are in debt. They're buying just dumb things, and I thought it was about time to make something that spoke to these people, my friends, to help them to retire early and just not work until they're 80.
And so you're like, all right, well, I got a couple of buddies. They're making some money. and they're buying TVs and nice cars, renting, and you're like, enough's enough. Let me start a podcast, and just because it's such an easy flowing podcast. It's you and another gentleman just kind of talking about everyday life of what people go through. So what, you started the podcast in 2012?
Yeah, so I actually had a specific friend who was terrible with money, and we would just get on Skype, and I would basically just yell at him for all the things he was doing wrong. And my wife was like, "You should record this." And yeah, so we kind of just cover the gamut. We don't get preachy. We share a beer or wine or cocktail and just take it easy.
What do you think some of the biggest mistakes that people are making? I guess in any age group. A lot of our listeners are probably a little bit more into retirement, where they've made some mistakes. They probably should have been listening, to a podcast like ours or yours, 30 years ago. But what I find is really cool is I would imagine your listenership is maybe a little bit younger, where you can tell them, square in the face of like, here, this is what you got to do. What do you see some of the biggest mistakes that, everyone across the board is making?
For people who are, like 30, 35, it's easy to be like, you need to invest. The time horizon is so huge. You'll just do well. And I think it covers everyone. But the one thing that people overlook, and I live in New York, so my cost of living is not, that of Canada. But your whole retirement is based on your savings rate. It's really simple. And, if you were never saving before and you have no debt, you could save about 50% of your income, you can retire in about 10 years. And so there are people who reach out to us and maybe they're 40 or 50 and they say, it's too late for me. And I'm like, no, not really. You just had a ton of fun when you were younger, and now you have to, buckle up and save like 80% or something, and you can make up for lost time.
That's it, huh? Just 80%.
No problem. Where do I sign?
But I love this movement too. I was talking to Big L earlier about the millennial movement of saying, hey, I don't want to work for the man. I want to either start my own business, work really hard, save as much as I can, and then be done by 40. And and I'm seeing a lot more individuals actually accomplishing that goal.
But that's the thing with the saving of 80%. Like it's laughable, right? But you could either spend less or make more. And I have a full-time job. I've had a full-time job. I have a full-time wife. I have a full-time family. I go out and drink. And somehow I started a business that earns more than my actual engineering salary. And I am not that smart. Like, I think that it's just like focused time, right? You have to I think it's something like on social media, people spend 600-something hours a year on it. Just take half of that and do something meaningful and don't give up.
600 hours? That is crazy.
It's crazy, right? I think it's even more on Netflix. I think it's like closer to like 1,300.
Oh boy.
Oh, I got to get my Netflix.
You're not even on Facebook, Joe, so you've got all kinds of time.
I do, and I don't even have cable. I should be saving 80% of my income. What the hell am I doing?
You should be the smartest guy in the room.
God, I am stupid too.
Oh, that's good stuff. So, Andrew, the millennials, so you're saying, obviously, with the time horizon, if they can start now, they can have whatever retirement they want. And, yeah, of course, it doesn't have to be 50% or 80%, but even if they put away, like, say, 15% for a number of years, they should have a great retirement. And a lot of folks aren't really doing that.
Yeah, and, that's the thing. I don't save 50%. I like my beer. I like all my things. I take Uber sometimes. But like you said, if you can be responsible and save 15, 20%, if your employer is matching a 401k, take advantage of that free cash. You could definitely get out before 65.
What do you think with younger when it comes to retirement accounts? Do you more or less push your listeners more towards Roth IRAs or traditional 401ks? So
I say that when you have matching, you should definitely get as much matching from your company as possible, because even if it was 25%, the return is ridiculous. 1 year you get that. I don't qualify for an IRA. A lot of the people in my audience don't as well. But there are things like if you open a business, you could set up a SEP IRA. If you have a high deductible healthcare plan, you could do an HSA and kind of like backdoor the whole thing. So it really depends on the situation. Although I will say personally, for me, I don't believe that a 401k makes sense because I hope that when I retire, I'll be making more than I did now.
Right. And so looking at the taxation of it, you'll probably be potentially in a higher tax bracket, and so you want to do the opposite to get maybe lower taxes on the way out than in.
Right. If I do it right, hopefully.
Let's talk a little bit about real estate, and I'll let you go. I know that you look and help individuals with real estate. Big Al's been a real estate investor for about, 30 years, buddy?
Yeah, about 30.
Yeah, and he's lost more than he's gained, so he needs your help.
Yeah, give me some tips.
Yeah, sure. Dude, I know you're a smart guy. I'm sure you did your math and maybe the tide went against you. But I don't believe in appreciation. I live in Hoboken and I've definitely benefited from that. But I think that if you go in where you're cash flowing well from the beginning and you're using correct math in calculating that, I think you'll generally do fine. And it really just comes down to researching a specific market. There are a lot of people who jump around, and I don't see anything necessarily wrong with that. I like to focus and perhaps hit like economies of scale where maybe my property manager cares a bit more about me than someone who only has 2 properties with them.
With the numbers, with the math, how are you looking at the math? Because we're here in Southern California, and the prices of homes are, I would say, comparable, to New York. Probably not as high, but we get individuals that say, yeah, I want rental properties here in San Diego. Well, the average cost of a home is $600,000, and then the rents are a few $1,000s. So, how do you help people pencil out the math?
Yeah, so it's actually really easy because I was sitting there with a spreadsheet and I wanted to kill myself, but I'm a developer, and so I actually built a tool that you could search an address. It'll pull the data down from Zillow. It'll run all the numbers, and it'll show you what your top line cash on cash is, and then I have an estimated 15% calculating for, and this is tweakable, for vacancy rates and major minor capexes like a wall falling down or something. And so you get like this medium term cash flow number that should hopefully weather you through most scenarios. So the people who listen to me and visit my site, I just direct them there. It's free. You just go, type in an address, and it'll tell you everything you want to know.
Where should people go?
If you go to pro.listenmoneymatters.com, you can create a free account. We don't sell anything to you or sell your address, whatever. It's really just a tool to help people make good real estate decisions.
Hey, man, you're doing a great thing. I love the podcast. It's light. It's fun. It just feels like I'm sitting there having a beer with you guys. So I appreciate you taking some time to talk to us and bring some perspective into your life.
Yeah, absolutely. It was a ton of fun. Thanks for having me on.
All right. Hey, guys, I want you... I'm sorry, go ahead.
Grab a beer.
Yeah,
Okay,
yes.
I'm switching now.
Yeah. It's the weekend, brother. So I usually drink Coors Light. I mean, I don't know half the stuff of that fancy craft beer stuff that you guys drink, but I might have to try some of it.
Well, if you give me an address, maybe I'll send you some from New Jersey.
Folks, that's Andrew. Check out Listen Money Matters. You can download that where all fine podcasts are available. Andrew, what do you think there, Big Al?
I like it. Got some real estate tips. Just to clarify, Mr. Joe Anderson, I've actually had a lot of successful real estate investments.
I knew that was going to come.
And I've had a couple poor ones also. But it is interesting how you seem to remember your poor ones better than you reflect on your good ones, right?
Oh, man.
Anyway, but I agree with them. I think cash flow is king. Now, it's difficult in Southern California to get a decent cash flow. And so if you're going to invest in real estate in California, there probably is going to be a long-term appreciation factor. But, boy, you got to make sure you have the cash flow going in. I mean, case in point, people were down in the downtown area before the Great Recession, were buying condos for whatever, $1 million, and you looked at the cash flow, they were losing $1,000 a month, $1,500 a month, but they said, that's okay, because I'm making $2,000 a month in appreciation.
I live downtown for many years.
Yes.
And I lived in one of the high rises by the ballpark, right? And I moved into that building in 07, 08.
Yeah,
right?
that was right on that cusp of
But
that. Huh?
everyone bought into that building years beforehand.
Sure,
right?
sure, right?
Like 05, 06, and they're like, all right, well, this is going to be by the ballpark. You know, a 700 square foot studio condo was going for $750.
Yeah, right.
And then by 2008, they'd be lucky if they could get it for $400. You know?
Right.
So yes, it is. And then the HOA fees are $800. Right?
You can't-
You gotta charge $6,000 in rent
to cover it.
just to cover it for seven. Yeah. You got to run the numbers.
You do have to run the numbers, and plus something else about that, Joe, is you got to have a lot of cushions in there. So you run the numbers, but you can't assume everything's going to go perfect every month. In other words, you're not going to have a tenant some months. You're going to have repair bills some months. Things come up, so you got to have factors for that. And some people, I would say San Diego, the average vacancy rate's 5%, but that doesn't mean all landlords get 5%.
That's an average.
Some are professional. Some it's like 10-20% because they're a little bit slow at re-renting. So assess your own abilities and then have plenty of cushion. Make sure your cash flow is there in good markets and bad markets. And probably San Diego real estate will continue to appreciate, and that's a good thing, but make sure you can afford it along the way.
So you're good at math, right?
Yeah, pretty good math.
All right. So here's an average for you.
Okay.
Let's say you got a freezer. Okay. What's the average temperature of your freezer?
Freezer, let's say 20 degrees. I don't know.
20 degrees. Okay. Let's say it's 0. It's a really Arctic freezer.
It's your freezer.
0.
You like your beer really cold.
Right. Yes. Right. And then let's say you have an oven.
Okay.
Okay.
It's
And
called at 400 degrees to bake a pizza.
Okay. So then, no, that doesn't work with my example.
Okay.
Let's say it is 200 degrees.
Okay.
It's a little slow cooker.
The slow cooker.
All right.
Slow cooker oven.
200 degrees.
Right.
Right. And so what's the average of that?
That averages 100.
100.
Okay.
Okay. Can you live in 100-degree temperature?
You can. It might be a little uncomfortable,
It might be a little uncomfortable.
but you could.
You could, hey, sometimes a tropical island might be 100 degrees.
Yeah. Just hop in the water,
Right.
get refreshed.
So you know where I'm going with this, right?
I do.
Right. So if you put your head in the freezer, right, and your feet in the oven, your body temperature is not going to be 100.
Yeah, the average
And what's
makes
the
no
average
sense.
temperature of your body?
Yeah, it's about
Close to-
100,
close to 100.
98.6. Yeah.
98 point.
Well, look at you.
It's all
working
came
at-
together.
You spent days on that analogy. Yeah.
All right, I got another question that
Okay.
we're a little bit behind from our email
From our-
listeners.
okay, what do you got?
So this is not from Investopedia that
Okay.
we kind of make fun of. These are from our
These
fans.
are good questions
yes.
from our listeners.
Yes, and of course, you can always go to info@purefinancial.com.
Let's get it right.
Or just email Alan or I directly.
Yes. Joe
Dot Anderson. And
Alan.Clopine.
there you go. Okay, Joe and Big Al.
Okay.
I like how he called me Joe instead of Joel.
Yeah.
Most
That's someone who's
yeah.
listened more than
Big Al and the other guy.
Yeah. It used to always be Big Al and Joel.
So thanks for always an informative and entertaining show.
Well,
Wow.
that's 2 compliments in a week.
Gosh.
That's unheard of.
Cherry picked. I got 100 that I had to shred. I just retired at 60. Am married. No children.
Okay.
Have no debt outside my mortgage. And
Right.
have more income from sources than needed to meet my needs.
Ooh, I like that.
Okay. In fact, in retirement, I am in 2017. He's anticipating to be in the 33% tax bracket.
Oh, my.
My home mortgage interest is the only significant tax deduction I have.
Okay.
All right. So he has been supporting my widowed mother, who's 80,
Okay.
with a monthly deposit as her primary source of income is Social Security.
Okay.
Between these two revenue sources, she's comfortable living on her own in her paid-for home. Her investments are small and safely invested, so there isn't really income from those. All right. She has a long-term care policy, and he is the sole beneficiary of her estate when she passes.
Okay.
What I was thinking, would it make sense to buy her home from her at a market price of, say, $200,000, with her financing my loan? The payment would substitute for my current monthly stipend, thereby allowing her to live in the home, receive enough income as she does now, and I would have an additional tax deduction for the interest, property taxes, etc. When she passes, my payment would cease, and I would own the home free and clear. This just seems like a good way to continue to do what I'm doing to support her, but at a benefit for me regarding taxes. Am I missing something? Or do you have any advice regarding moving forward with this plan? Many thanks. This is from John.
From John. I thought you were going to say it was from Dennis. That's a John. Boy, you've been thinking about this. I like it because you're paying your mom anyway, right? So maybe there's a way to get a tax deduction to boot. Let me sort of maybe try to recap what I think you went through, which is mom has a home that she's living in. Is that right?
Yes, it's paid off.
That's paid off. So mom sells you the home at market value, call it $200,000, and she basically seller finance so there's a loan. Okay. So at any rate, then for you to there's a couple ways to treat this. One is it's a rental property. Another is it's a second home. So let's start with if it's a rental property. It counts as a rental property only if she's paying you fair market rent, which I don't think she's going to be doing because you're paying her. So this would be a second home instead. And so therefore, as a second home, you can still write off all the mortgage interest and all the taxes. The mortgage interest, as long as both loans, let's say, we don't know what your loan is on your residence, but as long as both loans are less than $1.1 million, you can take a deduction. So that does work. One of the downsides, though, is if she were to live another 10 years, let's just say.
The appreciation of it?
Yeah, the appreciation of the home, and you inherit it, you would get a full step up in basis. Let's say it's worth $300,000 at that point. Maybe it's not going to be that much, but anyway, you would get a new step up in basis. So if you were to sell the property, there'd be no capital gain. The way you're doing it, if you sell the property when you finally, when she finally passes, because you don't necessarily need it anymore, your basis is $200,000, not the higher amount.
So the tax benefit that he might receive by doing this, he might have to pay it all back in capital gains tax if there's appreciation in the home.
Yeah, you kind of would have to pencil it out. I can't do it all that in my head, but those would be kind of some of the pros and cons of doing this. But yeah, I like the idea because you're paying mom anyway, right? And so why not get at some interest and property tax deduction? And that does work. That actually does work. It's I think it's more of a tax basis type issue, which you would be like, what if she lived to 100? She's 80 now, so that'd be 20 years of appreciation that now you would have got at a higher basis by inheriting it, but you don't get because you bought it when it was cheaper.
A lot of things to consider.
Boy, I'll say.
See, you can tell these are your money, your wealth listeners.
These are good questions.
Now we're going to switch gears a little bit, and we're going to see if we can find some good email questions from Advisor Insights. Investopedia. If you guys haven't been to Investopedia, that's a good place to go.
Okay.
I am not compensated by Investopedia. I did, however, receive a pair of socks that I am wearing today.
Oh, those, huh?
Yeah.
You've got one pair of socks or more than one?
No, just one.
That's it. That's all you got for?
That's all I got
for doing all this.
For doing all this stuff for the.
Boy, that's like less than minimum wage.
I do want to be. That's my compensation for reading.
So in other words,
there is
a conflict.
Answering their questions.
There's a conflict of interest.
There could be.
You got some socks. You might get some more socks.
I might get a T-shirt. That's what I'm thinking on.
Right.
Okay. All right. How can I determine capital gains tax from the sale of a rental property? So here you go, Alan.
Oh boy.
My ex-husband and I own a single home rental property in Hawaii.
Oh, I like that.
We both live in other states. It was our primary residence beginning in 2010.
Okay.
And changed into a rental in 2012.
Okay.
It has since been a rental in which we've claimed depreciation through 2016. We purchased the home for $255,000, and it has a current mortgage balance of $238,000.
Okay.
The total depreciation claimed since 2012 through 2016 is about $4,200. If we sell it at a regular sale, not as a business rental, for $400,000, how can we calculate the capital gains tax?
Okay, that's a good question. Let me make sure I got all these numbers right. So they bought it for $255,000. Is that what that says?
Yes.
$255,000, and they're depreciating $4,200. I assume that means per year. Doesn't say that, but that's
it says the total depreciation claimed since 2012 through 2016 is about $4,200. So they didn't calculate their depreciation correct.
That's wrong. But let's just assume that's what they did. Let's round it to $5,000. So you take the $255,000 that they bought it for, $5,000 of depreciation. So now their tax basis is $250,000. So you take $250,000 off of the $400,000 is what they're going to sell it for, and we're not considering closing costs. We're just making this simple. So you got $150,000 long-term capital gain. Right, so that's how that works. And that capital gain, depending upon your tax bracket, is either taxed at 15% or 20%. And in this case, it's depends on the rest of their income. As a married couple, you'd have to have taxable income above about $470,000 to get to that 20% capital gains rate. So it's probably 15%. I'm guessing, 15% federal rate. That $5,000, which I'm making up on depreciation, you have to pay 25% rate on, 25% tax rate. That's called depreciation recapture. But yeah, roughly 15% of $150,000, for federal purposes. So that's what, $22,500. That's your federal tax, plus a little bit more for that recapture.
They should have been taking close to what, $5,000 a year.
$4,200 is about right per year. Yeah, I would say. I don't know if that's what they mean or not, but
so what is how do people look at that?
If they'd taken the right amount? Or what do you mean?
Yeah, how do you calculate what they should have taken?
Yeah, so you take the purchase price at $255, and then you got to figure out how much of that is land versus building. And a lot of accountants will just arbitrarily say 75% is building, and 25 or 30% is land. You want a higher building allocation because you get to depreciate the building, which means you get to write off the building over time, or the house.
Over 27 years?
27 and a half years. So you take that $255,000 times, call it 70%, whatever that is, you divide that by 27 and a half years, and that's the amount of depreciation that you can take per year. Probably, I'm guessing it would have been closer to $6,000 per year,
right.
And they had it as a rental for 4 years, so they should have had about $24,000 or $30,000 of depreciation, not 5 in our example, but at any rate, that's how you calculate this. Now, a couple other things to realize, though, is depending upon the amount of adjusted gross income you have, if you're a married couple and it's over $250,000, now you got to pay that Medicare surtax of 3.8%.
So if they had, let's say, an income
of
100 and some odd thousand, because that capital gain,
that's
in your example, was 150.
Yeah, let's say they had $200,000 of other income, and this 150. What's that? That puts them up to $350,000. So now $100,000 of this gain has an extra 3.8% attached to it because it's over $250,000, and $50,000 does not. So really, your capital gain for most of it in that example is like 18.8%, not 15%. Then you got to pay state of Hawaii taxes because Hawaii has taxes. It's actually not quite as high as California, but pretty darn close. Then you have to look at the state that you're living in, and then you decide, does my state have higher or lower taxes than Hawaii? If it's lower taxes, well, you don't have to pay taxes in your own state, but too bad, you're out of the pocket for the state of Hawaii taxes. If you live in California, well, California gives you a tax credit for taxes you pay in Hawaii. So you take your California taxes minus the Hawaii taxes, and you pay the difference in California. Nauseating, isn't it? But now our listeners know information you can use.
How many car accidents just happened because they fell asleep? It's like,
I don't know how to make this any more interesting. It is what it is. Let's hear you do it.
See. So I got to pay tax in 2 different states, but then I get a credit?
You do.
California credits me, whichever's higher.
Well, yeah.
But then I got to file a California return, and I got to file a Hawaii state return?
You bet. That's exactly right. So you better be really good at TurboTax or hire somebody to help you.
Well, a little shameless plug for
what?
Financial.
Oh, I don't do taxes anymore. That's long gone. I used to. That's how I know all this nauseating stuff.
Oh, God. I don't get it. What do you think about target date funds to
target
wrap
date
up
funds.
the show?
Okay, I'll give you my answer, and then you can clean it up. Right. So target date funds are like retirement account funds where it depends upon your age, or depends upon when you're going to retire, 10 years, 20 years, 30 years from now. And the funds in that particular investment are invested based upon you getting close to your retirement date. The closer you get to retirement date, then it'll be more fixed income safety. I generally, Joe, I would say I like them in general, but there's a couple problems. Some of them are expensive, so you got to look at the internal costs in those. Some of them are cheaper, so be aware of that. And the other thing, too, is it's going to put you in an average with everyone else, which may or may not be the best thing for you to do, but it certainly is probably better than doing absolutely nothing.
I think target date funds are great for investors that have maybe $100,000 or less. I think it's a good plan to get a diversified portfolio.
And real easy.
Yeah, real easy, right? It's just chug and there you go, right? Plug and chug? Is that what the terminology is called?
I think so.
All right. So then it's diversified, and then as you get closer to your retirement date, then it gets a little bit more conservative. But, however, you've got to be very careful with some of these because in most cases, right, they're for unsophisticated investors because they don't want to deal with anything. They just want something simple, right? So how do most people select their investments, Al? What do they look for?
Well, they look for the rate of return for the last year.
They look at past performance. Past performance means nothing of future results, right? We all heard that before, disclaimer. So, but different target date funds have different allocations. And so let's say you go to Vanguard, you go to Fidelity, you go to T. Rowe Price, you go to whatever, right? There's hundreds of them. And then you look at, all right, well, which one is the best target date fund? And most people are going to pick the one with the highest return, and they're going to equate that to the best one. However, that's a lot more risk. They might have 80% in stocks, while maybe another target date fund with the same target date has 55% in stocks. That doesn't mean the one with 80% is better because it has a higher return. It's just taking on a heck of a lot more risk. And then if you're taking on more risk, right? What is that going to do to the overall portfolio when markets go down? As you're taking distributions from the portfolio as well, I hate target date funds because it's like, all right, well, if I'm going to sell a share of that mutual fund, I'm selling stocks and bonds.
There's no way to separate.
There's no way to separate it. There's no way to really calculate the risk that you want to take in the portfolio. There's no way of segregating the risk in the sense of creating the income. There's no tax efficiency whatsoever in the overall accounts. So, that's kind of my 2 cents with them. I think it's a good start, but buyer beware, I guess. That's kind of the whole theme of, full circle, right?
Okay, got it.
So hopefully that helps. Go to our website, purefinancial.com, if you want more information, if you want more help, if you have a question, go to our website, ask an advisor. We're here for you to answer anything that you got. So we'll see you again next week.
So, to recap today's show, you need a strategy for retirement withdrawals, you need a strategy for claiming your Social Security, and you need a strategy for investing in real estate. Special thanks to our guest Andrew from the Listen Money Matters podcast, who explained why, if you can save 50 to 80% of your income each year, you already have a great strategy for retiring early. Listen next week for more Your Money, Your Wealth, presented by Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision. Your Money, Your Wealth opening song Motown Gold by Carl James Pestka is licensed under a Creative Commons license.